Thank you so much, Maria, for this kind introduction. It's a privilege to be here at this amazing event and share some perspectives about the future of the industry. And there's one thing I can tell you up front, the future of the industry will not be boring. There will be a lot of change ahead of us in the next 10 years, so I'll talk a little bit about that. So let me see, I should, in theory, have a few slides here. Maybe if the support team can see whether we can somehow bring them on, that works perfectly. Before we talk about the future, it might make sense to just talk about, where the industry stands today and get a little bit of an alignment there. And the subtitle that you see here, Private Markets, the New Traditional Asset Class, I think is a nice way of describing it. So let me spend a few minutes explaining what we mean by that. I think at the essence of that claim is a conviction that we have seen a role change between public and private markets. A role change as far as the financing of the real economy is concerned. And that's actually pretty straightforward thought. If you look at the IPOs, the public market financing tools 40 years ago, they would finance profitable, proven companies in the established real economy, okay? And an IPO was a pretty strategic corporate development event back at that time. If you move forward 40 years, you'll see that today IPOs are much more dominated by hype assets. Some of the assets are too big for private markets, but more often they're just hype assets. In most cases, they're actually not profitable companies that IPO, very technology focused, not the broader industry. And so in many ways, the industry, the IPO industry has moved from something that was very traditional to quite opportunistic. And if you look at private markets, you see nearly the opposite change actually. We have started back in the 80s, driven by an incredible high-yield industry, in investing with enormous amounts of leverage in consumer industrial businesses that would be constrained in their growth. It was usually kind of a dismantling strategy involved, like event-driven strategy, would sell the stuff after some while. So there was certainly no financing of the real economy concerned at that time. And if you move forward today, you see the private markets, they are very established, very long-term, across all these sectors, and they more often than not, they invest very solid, growing businesses of the real economy. So a real change of roles. Why is this happening? So there is a tendency, and that's our hypothesis, that IPO markets finance what we call spotlight companies, whereas the private markets typically back more foundational businesses. Let me explain that. So a foundational business is a business that produces some form of, I would say, established product or service, can be very high-tech. That can be like a software, for instance. If you take the example of the food value chain that you see in the chart here, you'll probably see that most of the activities in the agricultural space, including very modern ones, like berry nursery businesses, biologics-based, or biological support products. So they all tend to be very foundational businesses, B2B businesses very often. The same on the processing side, new restaurant chains, and then the whole supporting infrastructure activities that you find. And that is very different from spotlight businesses. And spotlight businesses have a little bit more of this I would say, hope factor involved, right? There's either maybe an aspiration to build through a platform a massive business, scale up in a massive way. Sometimes there's an ambition to launch something new, a new product, a new technology, IP-based or brand-based. And if you look at the food chain, I think a better example for such a spotlight business is, for instance, DoorDash, okay? And let me be clear, it's not about being judgmental, whether one or the other is a good or bad business. That's not the point. That's just different businesses. And fundamentally, the IPO markets these days back increasingly the spotlight businesses. Why is that the case? Because they get a better valuation in most instances. And this is because there is this Google factor. So investors in these businesses, they believe they can maybe invest in the next Tesla, Nvidia, Google. That's kind of driving the valuations. And that is very different from foundational activities that often end up in private markets because the private markets pay the same price. I don't think they pay less, but I think it's about the same price that you get in IPO markets, and then you rather stay actually in private markets. Just to be clear, if I talk about these foundational activities, I'm talking about financing of new developing companies. So a Nestle, Unilever would be very foundational, of course, and they're a public company. But that is because they're a legacy asset that came to the market many, many years back. So let me give you some numbers to give you a little bit more of a foundation for these claims. On the left-hand side, what you see on the chart is the number of IPOs over the last decades. And what is very evident is that at the turn of the millennium, you've seen the number of IPOs coming down massively. But there's something more interesting happening here that you don't see on that chart. If you go and look through these bars what kind of businesses IPO'd in these respective years, you'll see that since 2020, IPOs happened mostly, since 2000, happened mostly for businesses that were too large for private markets, or more often, that were spotlight businesses that got a better valuation, often unprofitable business. So if you look at the right-hand side of the chart, I mean, that gives you a bit of a sense of how this speculative element in public markets has actually moved over the last decades. What you see in that chart is the percentage of companies in an individual year that did an IPO that had positive earnings at that time. And that's just normal companies, right? No SPACs, no penny stocks and stuff like that. And you see how that number has come down. And in the last few years, 4 out of 5 businesses that were IPO'd were actually not profitable. So there's a massive change of the industry, of the IPO industry in public markets. So where does this leave us? It means that the more foundational businesses are hardly financed by IPOs, they are financed in private markets. And that is very key also for the future, because if you think about the next generation of the economy that is built, I will tell you that most of the activities are actually very foundational and therefore will be opportunities in private markets. What you see on this chart here is 24 what we call mega themes in our firm. These are value chains, or you call it maybe ecosystems in economy, that are subject to very profound change and come with a lot of interesting opportunities, very modern activities that are being developed. If you look at the third box on the top left, this is the food value chain. And you see this little iceberg, if you see it from the distance there. We filled the lower part of the iceberg to flag that in this value chain, most of the activities are very foundational, or not a lot of spotlight activities. If you do the exercise for all of these 24 themes, you will actually realize that in most of them, there's many more foundational activities, and that opens up these dramatic opportunities for private markets. Now, some of you will say, that's all interesting, but how comes that public markets are so much bigger than private markets, if that's the case? Well, it depends on how you look at public markets. People always look back and look at total stock size. That doesn't matter. You have to look forward. Looking forward means you look at transactions or you look at fundraising. And if you look at fundraising, for instance, you'll see that since 2016, we have seen more fundraising in private markets than global equity issuance around the world. Okay, so the private markets have become bigger than public markets when it comes to new transaction, new financings. So there has been a change of roles. There has been a change of dominance in financing. Let's talk a little bit about the future. There's 10 hypotheses that I want to share with you. The first one is really about the consistency and the sustainability of that development. I mean, is the change we've seen structural or is it more tactical? Is it just because of rates? It's very hard to give you a scientific proof of our conviction that this is very structural, but I show you maybe some numbers here. The gray bars are the fundraising bars we've just seen before. And what you clearly see is that this is not a development over the last 4 or 5 years. Okay, this goes back now for 30 years. There's cyclicality in there, but it's a very long-term trend. Very similar if you look at this ratio of the percentage of profitable companies at the time of the IPO, that started to go down in the 90s. End of 90s, okay? And there was, of course, around the millennium, there was a big change here. It went up again. That's quite normal after crisis. You see a little bit more profitable companies being IPO'd. I expect the same for the next 2 or 3 years, but there's clearly a trend line. Some people have argued in the past that it's natural to see more private market activities because with all the vast amount of leverage that was available, if you have a profitable business, you would not IPO, you will get the leverage. It's not a very convincing argument because if you look at this greenish line there, gray greenish line, you see the leverage in the industry as it comes down. So it's actually negatively correlated with the actual activity in the industry. And then of course you can look at rates, but also rates weren't at zero for a big part of the 30 years. So we believe it's a very structural change. There are people who are much more knowledgeable about the psychology of IP markets than I am. What they would tell you is there is one big reason for that shift. It's the institutionalization of asset management, index investing by institutions, with the IPO markets becoming a much more retail broker-oriented market, hedge fund-driven, retail broker-driven. That has changed a lot the psychology of the market, getting to a more speculative market. So let me talk about 2 very fundamental drivers of change in the next 10 years in the industry. One has to do with the investment context. I'll talk about that in a moment. It's about the transformation of the economy that we are seeing in the next 10, 15 years. Okay, that's the investment context. The second one is more of structural change. It's the democratization of private markets. A lot of people talk about it, but I'm not sure whether people sometimes miss a little bit the key point around that. I mean, why is it relevant? Because it's a very large opportunity. I mean, it's a market that has a size of about $160 trillion if you include mass retail, mass affluent, and DC funds, 401k funds. If you invest, let's say, rather than the 1% today, maybe 9-10%, the additional AUM has the size of the entire private markets industry today. So it's very relevant. But maybe more interesting is who's actually the gatekeeper of these monies, because that's not private market firms. That's traditional asset managers. It's the wealth management teams of private banks or large banks, global banks. And you see an overview here of the largest 10. These large 10 firms have two things actually in common. The first one is they've hardly invested or allocated to private markets. It's 1%, 2, maybe 3%. Okay? But the second thing they have in common that they share, they have all very, very big ambitions to invest 10, 15% in private markets over the next cycle. Now, if you make the maths, these are very, very, very substantial amounts. So how will that change the industry? I would tell you it's in two ways. It's in terms of size, but maybe more importantly, in terms of DNA of managers involved. So let's go a little bit through a hypothesis how that market change could look like. Size and DNA. Today, about $10 trillion, that's the first line that you see there. It's an industry that is dominated by private market firms, so they have private market DNA. They're all pretty much specialists in private markets. There's an assumption that existing investors might double their allocation. We'll be a little bit more conservative in our assumption. So let's say there's another $5 to $10 trillion in the next cycle coming from mostly institutional existing investors industry, probably using the same managers to a good extent, so maybe very similar DNA. But now let's look at the top 25 traditional asset managers that get into our industry. They have about $70 trillion in management, so that would easily add about $5 to $10 trillion. $5 to $10 trillion. Some of them might have small teams, they bought a boutique here and there, they have 20, 30 people here and there. But you're not talking about investing billions, you're talking about investing trillions, literally, okay? So keep that in mind. They have essentially a public market DNA, a public market team, and they want to play at scale. Pretty much the same for the next, 100, 150 asset managers with about the same size, and also this very much public market DNA. So think of the industry in 10 years, 15 years after the next cycle as an industry that might have tripled again to about $30 trillion. But there's a problem. I don't think the problem is actually the size. I want to mention that quickly. That's not the topic of today, but I still want to mention it. The size is not an issue because the set of opportunities in the next 15 years will be absolutely vast. This new generation of businesses that need to be financed in private equity. There will be market share taken from public markets, quite significant market share actually. There will be a real estate transformation because people will rent and not buy anymore. There will be a transformation of offices. But who's owning real estate? It's pension funds. They don't do that. They don't do value add, opportunistic, things like that. So the conduit will be private markets. The infrastructure, energy transition, green transition requires $2-3 trillion a year. That's not happening in public markets, not by governments. So the opportunity set will be vast. That is not the problem. But I think what you should focus on is this heterogeneous space where you have suddenly a lot of public market DNA in an industry that was characterized by private markets DNA. So what could that mean in our hypothesis? We believe that we will see in our industry also a bifurcation between more passive and more active approaches. Now, active and passive is a well-known concept in public markets. It refers to activities at the portfolio management level, right? Investment or stock selection level. What we mean here is something very different. We talk about the governance of assets. So a passive approach is if you have a financial mindset, maybe some form of sector allocation, and you just participate in deal flow in private market opportunities. And then you buy them and you hold them, but you don't really govern them actively. You don't have additional resources you bring to the management team. So it's a public market approach to private market. And so in a funny way, I mean, a passive private market approach is close actually to an active public market approach if you want. Now, active and private market, as you know, means something very different. It means that you have actually a thematic mindset. You don't care about a strict allocation according to sectors. You focus on these mega themes. You focus on where transformation is happening, where there's potential to build and develop businesses. It's a very different mindset. And you focus on that business transformation, and you bring a vast amount of resources with you. I mean, to help the management team to design the boards and all of that. So think of this industry now at the $30 trillion that started today as an industry that was certainly more active than passive, even though today some large-scale oriented firms will probably be a little bit more passive. But over time, you see probably that is shifting and it will be much more balanced between active and passive. How should we think about returns and the results of that kind of industry going forward? And this is where we believe you will see a phenomenal return dispersion. There has always been a much bigger return dispersion in private markets than in public markets, but that is actually going to grow in the next 10 years. So if you think about this continuum between active and passive, what is very likely is that investors that don't have the resources to play at scale, they will be relatively passive, and they'll probably look all for very similar businesses. They look for businesses that they feel they're relatively resilient. I would call them, in quotes, core kind of businesses, where they feel that they cannot make big mistakes. They do a good due diligence, they buy the business, and they should be fine. I think that can be very risky for two reasons. The first one is that that space will be enormously crowded. Think about all that money that is actually entering that space and looking for very similar activities. But the second one is maybe even a bigger point, and I'll talk about that in a moment in more detail. We're just at the beginning of, again, a major transformation of the economy. And the question is, how many businesses are just resilient by the type of business that they run? And I don't know whether there's actually a lot of businesses that per se are resilient. I think the resilience comes actually from building it and not from buying it. So on the active side of the equation, you'll probably find an enormous set of opportunities, to build, to transform businesses in this economy that is in an incredible change in the next 10, 15 years. Less crowded, and this is where probably you achieve real outperformance compared to private markets in average, but also certainly to public markets. In other words, if you approach the asset class with a public market mindset, and a DNA, an approach, you will likely get public market returns. I don't think there's anything miraculous about private markets. That's just by the fact that you enter it, that you make returns that are better than in public markets. Let me talk briefly about this incredible recalibration of the economy that is ahead of us. And I know that everybody's aware there's four big drivers. There's the macro side of things with rates mostly, but also exchange rates. There's geopolitics with reshoring, deshoring, all these kind of things. There is all kind of technology advancements that we see, and there's a societal part of it. My personal conviction is there's much too much focus on the rates, on geopolitical dynamics. And of course, that has an impact. Of course, the free lending is over. And of course, certain supply chain investments are not opportune anymore today. But the bigger thing is probably what's happening beneath the surface in the real economy. I would compare the situation today with new technologies framed around AI, but it's not only AI, with the situation 25 years ago. If you recall 25 years ago, what happened is really two events at the same time. It was wide accessibility to communication and connectivity with a new generation of computation power. And these things led to a real transformation of the economy. That was what built the digitization of the economy. Not just internet companies, platform companies. It had vast impact in creating biologics, understanding DNA, and all of these things. I think today we are probably at the moment where AI and some related technologies, together with new systems to run data management, computation power, all of that is probably leading again to a very, very significant transformation of the economy. But I would tell you one thing, it will not take 25 years anymore. I mean, probably Moore's law that tells you that, in transistors development or ultimately chips, you saw a bit of a doubling like every 18 months or so of effectiveness. Now, Moore's law applies to much more than chips and transistors. It's actually what you can absorb in pretty much all research areas. So there's a very good chance that in the next 10, 15 years, we see a real transformation of the economy. Profit pools will be redistributed again like in the last 25 years. This is an environment where this idea of I buy resilience, I think is a very naive idea. The only way you can create resilience is by building it. That will have a big impact to the industry. especially for active investors. Because let's not forget, the industry was born out of Wall Street, out of like leverage and lending. That's where we come from originally. But that's not how you actually transform businesses. In a transforming economy, you need to transform businesses. Where do you learn that? It's from the best industry groups. There's 5 typical areas of success that the best industry groups in the world have in common that they excel in. That's the strategic rigor. That's the way they have a very, very fine-tuned, very active but decentralized governance with the best people at each asset that they own. It's the focus on value creation, not M&A. They might do M&A for technology, things like that, but the big focus is actually a vertical consolidation of the market, meaning a product-based consolidation and not a company acquisition strategy-oriented consolidation. There is systems, processes, and there's leadership development. So if you think about the transforming economy and what it takes to succeed, I think you will see that in 10 years' time, by latest, that the most successful private market firms, they look much more like industrial groups than financial services firms. It's also a reason, by the way, why we have a number of CEOs in our investment teams, and I say investment teams, not just on the boards and in our management team. They work in our investment teams for exactly that reason. So let me share maybe one perspective around returns. The obvious question these days is how should we look at returns going forward? So I don't have the crystal ball, but I would tell you there's a simple exercise you can do with your own portfolio to get a relatively good sense. It's very, very simple. Take your portfolio and strip out all effects from valuation changes and leverage. Effectively look at earnings growth in your portfolio in the last 5 years or 10 years. We do this in our portfolio all the time. That's our portfolio on the infrastructure side and on the private equity side. If you look at public markets growth in the last 5 years, not an easy period. I mean, we had a bit of tailwind, then COVID was coming in, then valuations came a little bit down. Inflation has grown, nominal growth. We see there was about 6% growth on the public infrastructure, that's S&P and Dow Jones. We had about 15% that time. In public equity, there was about 5% earnings growth over the time. We had about 20% at that time. Do that exercise because I think there's a good chance that the returns you'll make in the next 5 to 10 years will be very, very directly correlated to the actual earnings growth and not to other factors anymore, which was very different in the last 10 years. I want to add one other perspective around ESG. A big topic these days is, is the private market industry hiding behind, for instance, a lack of reporting, a lack of transparency? Is it arbitraging the system? And I would tell you, first of all, I think the contrary is actually true. I always joke internally, we're probably the most regulated private markets firm in the world because we have a lot of wealth management products also in the US, in the UK, in Asia. And there's probably more reporting we have to do for our portfolio companies than most public companies would do for their subsidiaries. So I think the pendulum has actually swung to another extreme here. But maybe that's not so relevant. I think what happens today is a bit of finding process. It reminds me a little bit of the differences in accounting standards in the 90s, where there is over time a convergence taking place between public and private markets, between the different regions. And so I think that's the process we're in. So I wouldn't worry too much about that. Private markets will be a super clean place, and there will certainly be no merits here in doing something bad on the ESG side. And there's no ability to hide. Maybe more relevant than the question of reporting, I think, is how you actually run these businesses. As private markets become the stewards of the real economy, there will be much, much more attention and focus on how do employees of these companies actually feel about their owners. And I think that will change. I think the focus will be not just on financial returns, like arguably there was 10, 15, 20 years ago, and much more around what kind of business you build and how happy are actually these employees. We launched our own stakeholder benefits program end of 19, exactly with this idea to do that. We made a commitment to reinvest up to 10% of EBITDA growth or earnings growth in employees, financial participation, benefit plans, care for families, development, things like that. And I know a number of other groups like Ownership Works have in the meantime followed. And so I think you will see a big focus of that, and people will measure managers by the way they run these firms. So with all that change that we talk about, structural investment context, the size of the industry, what will that mean to allocations? I can tell you one thing, that is Our largest investors today, that's sovereign wealth funds, some very large public pensions and private pensions, they're in the midst of changing their allocation strategy quite significantly. And they're actually in the middle of implementation and allocation that will probably go to something like from 15-20% today to 30-40%. And it's important, that is not just driven by the size of the industry. That's actually not even the primary factor. Very often this is driven by the realization that the access to these foundational businesses, to many of these businesses that create the next generation economy, they will be funded in private markets and they will not be funded in public markets in many instances. And the allocation strategy will also become more focused on the nuances of private markets, active, passive, things like that. So I hope I leave you with some thought-provoking perspectives here about our industry. I'm absolutely convinced that we have already seen that change of roles between public and private markets, but with the investment context, a new transformation of the economy that is ahead of us in the next 10, 15 years, plus new entrants coming from the democratization of the markets, I think you see vast change. Massive opportunities, bifurcation between active and passive, active core will win, and I think that will essentially bring new allocations with it. The most important thing for the next 10 years is you cannot invest in agility, you have to build the agility. Thank you very much.